Good afternoon. This is Brian Shannon from AlphaTrends.net. Today is Tuesday, the 9th of September, 2008, and the market gave up its gains from yesterday. Did I mention that it's a day trading environment? Anyway, again, the only thing that we can do in this market is control risk. That's our job. And right now, we've got a super volatile market environment, and it makes that moniker of risk management even more important now than any other time. If you're bullish one day, the next day the market comes and just takes everything away from you. The market yesterday, S&P 500, looked like it was getting back into the range of this 126.5 to 130.5. We still have the declining 50-day moving average, and I was thinking that maybe a pullback down towards 126 would be healthy, but when we have a declining 5-day moving average, you have to be suspect of these shorter-term moves. And today, when this market gave up the yesterday morning and afternoon lows right here at about 125, that's where it really caved in. We saw a little bit of strength on the open, and then the market got back below that daily VWAP, and from there it was pretty much downhill all day as the market remained below that declining VWAP for the entire session. So yesterday I thought, well, maybe this market could recover and perhaps it dodged a bullet, but no such thing. You have to be really suspect of any move with the declining 50-day moving average and such a badly damaged weekly time frame as well. The good news is that all this frustration in the market is just going to eventually flush out all of the emotional participants, and then finally we'll be able to build a solid base. But we're not anywhere near there yet. I saw some real severe damage in some of the individual stocks today. So it seems as though in some of the stocks we're really getting people just kind of throwing them away. Some of the shipping companies, the coal stocks. I mean, just look at the coal ETF. KOL is down from 47 or so about 8 days ago to 32, and this is just a composite of them. If you look at a stock like Arch Coal and some of the other commodity related stocks like the steel stocks, AK Steel, let's see, we got STLD, etc. I mean, the dry ships, DSX, all these shipping companies are just getting hammered. So you've got to just really, again, control risk. And I get emails saying, how low do you think it can go before you buy it? And the point is, you don't wait for how low it can buy. That's anyone's guess. What you want to do is, if you're short these things, is just keep trailing your stops lower. I prefer to take it more in a day trader's environment, as I've mentioned in here, but there are some good trends in individual stocks that hopefully you're able to take advantage of some of those. The financials yesterday, I said that we're back to this range, and here's where we got up to the upside, to the upper end of that range, and we're back in the middle of it. This group sold off 6% in here today, so if you're trading the SKF, it had a huge move. But again, I think that these are meant for short-term traders, so I'm not going to really talk too much about the financials. The Russell 2000, this group again does hold up the best. It's still above its 50-day moving average, but as I pointed out yesterday, we have this pattern of lower highs and lower lows, so it doesn't mean buy just because it holds up the best. It's still pretty much in a range of basically $70 to $76, and as we know from the weekly time frame, that $76 level is a very big level that this market will have to overcome, and it doesn't look like that's going to happen anytime soon. The semiconductors were lower once again today. This group lost 3%, so another new low for the year and for the last several years. When we look at the monthly time frame, again, there doesn't seem to be much support until perhaps maybe down near $24. So as much as it's down, and it's down a lot, it's not down too much as long as there's more sellers in this market. You can't look at PEs and valuations and that sort of thing, because when emotion rules the market, a lot of those traditional valuation tools go out the window. We do have the potential in here, I'm just going to point it out again, for a turnaround in these semiconductors based on the MACD. Only price pays. I point out these MACD divergences because occasionally they do lead to some tradable upside, but when the primary trend is lower, as it obviously is in these semiconductors, it becomes a very, very risky trade. Only price pays, but the MACD divergence sometimes leads to a turnaround. If you're not familiar with that concept, look at the video on the side of my blog under popular posts. Yesterday I had pointed out in the Qs that we had seen the MACD MACD diverge in there. And as much, it diverged again today. We had a lower low, and still this MACD made a higher low. So the MACD can continue to diverge. It doesn't mean buy the market. It means take a close look at it and look for evidence. Yesterday, I thought that evidence was present based on the the purchase of the call options. This morning, if you were looking at my blog, I'd said I was selling a portion of them here, and that my stop was going to go under this level right here. And that level basically was the VWAP. The market broke back down below the VWAP right here. I'd taken profit on part of it here and sold the rest of them at a profit as well. So as much as you look at this market and go, well, it was down 2% and I was a call buyer yesterday, you can still make money as long as you manage risk. Risk management is job number one. And that's what Larry McMillan liked about my book, that basically the chapter on risk management, he said, was the key. And Larry McMillan, if you're familiar with options trading, is kind of the options guru out there. But the NASDAQ 100 doesn't show really any signs of life. It was down on lighter volume today. The MACD continues to diverge. But what doesn't none of that really matters. The only thing that matters is price, and it's still showing lower highs and lower lows. We've got a declining 5-day moving average. So even though I tried those call options, and I said yesterday the odds don't favor continued upside, but I was taking a shot. I was in the call options because I could control risk, and that's what you have to do in this market, is control risk. If you participated in the afternoon or midday event, some of the stocks that we had looked at got really hammered hard, that we're looking at as far as short sale candidates, and some of the long side candidates actually held up. If you purchase the book, on page 184 is the username and password for the bonus tab, and on that bonus tab, that's for the book website, that's where I'd uploaded the charts as well for these. But there continues to be no reason to be bullish for more than just very short-term trades in this market. We've got a badly damaged market, and it can continue that way until basically we run out of sellers, and that's not going to occur because of PE ratios, or because of an economic report, or because the federal government steps in to save any company. The bottoms are a process; they're not an event. We're coming down. It looks towards testing the year lows in the Qs, and there's nothing that says that they have to stay, that they have to hold up at that level. We could continue to just spiral lower out of this symmetrical triangle. If things change drastically, I'll update during the day. But right now, there's I haven't been posting much intraday because there's no reason to buy, and there's no reason to really do much other than short the weak stocks and control risk.